Now let's look at the final financial statement that we prepare under generally accepted accounting principles. We call that financial statement the statement of cash flows. Now, the statement of cash flows is very important to the reader of a financial statement because it tells the reader the sources and uses of cash. Now, we want to know where a company gets its cash and how it uses its cash because we can then make some predictions as to how they will look in the future in terms of the generation of cash and also whether they have enough cash to meet its obligations to its shareholders and its creditors. The reason for the difference between net income and net cash provided used by operations is a key question that is asked because you can make $1,000,000, but if you don't collect on your invoices, you will have no cash. The statement of cash flow shows us that even though we might have income, we may have very poor cash position because we lack internal controls in the collection of cash or the granting of credit of future sales. Now we also can determine the sources and uses of cash by our investing and financing transactions during the period as well. So in other words, there are three different types of cash flows. They can come from operating activities, investing activities, or financing activities. If you were to look at a balance sheet, you could determine the various areas of the balance sheet that would generate the three different types of cash flows. The operating activities section of the balance sheet is typically coming from the income statement items, which is what generates net income in the retained earnings statement. Also, the changes of the various balances of your current assets and your current liabilities. The investing activities are the changes in your investments, long-term investments, and your other long-term assets. The financing activities are the changes in your long-term liabilities and the capital section of the stockholders' equity. This slide shows some of the cash inflows and cash outflows that could occur in the operating activities section of the income statement and the balance sheet. Cash inflows can come from the sale of goods and services. It can also come from the interest received and the dividends received from our investments or our lending of funds to other people. The cash outflows could be payments for inventory, payment to our employees, payments to the government for taxes, to our lenders for the interest on our borrowings, or any other type of expense is an outflow of cash. In our investing and financing activity, here's another list of potential cash inflows and outflows. Just remember, the investing activities are normally the changes in the balances or the changes of activities to cause the balances on the long-term assets section of the balance sheet. On the financing activities are the changes or the activities that created the changes in the long-term liabilities and the stockholders' equity section. There are certain activities or transactions that occur in our financial statements that are not cash related that we still need to account for and understand that it may affect the changes in the balance sheet, and therefore we need to disclose that they are non-cash transactions that could potentially affect our statement of cash flows. So here's some. 1. Direct issuance of common stock to purchase assets. If I issued stock in exchange for receiving assets, my long-term asset account would increase, but so would my common stock account. That would also increase. No cash has changed hands, but my investing activities of the purchase of the assets would have increased, but also the financing activity of the issuance of the stock would also increase. So we would need to disclose that because of the change in the balances. If we were to convert our bonds into common stock, when we convert the bonds, the long-term liability of bonds payable would decrease, but the common stock would increase. Therefore, no cash has occurred, but we've had an activity or a transaction that would have changed the balances in those accounts. So, if you have non-cash activities that change the balances in the accounts that would have fallen under an operating activity, an investing activity, or a financing activity, you either have to create a separate schedule that shows the non-cash activities or create a separate footnote in the financial statements to disclose that these activities occurred. Now, there are two different types of statement of cash flows: the direct method and the indirect method. The direct method requires the preparer of the financial statement to take a look at the cash account and accumulate the debits and credits in the cash account so you can specifically identify what items have increased or decreased the cash account. The indirect method starts with net income and it adjusts the net income balance to recognize the non-cash activities, and then you can then see the changes in cash to determine the cash generated from your operating activities. The direct method and indirect method formats are only different in the operating section of the statement of cash flows. The investing activities and the financing activities will be identical for both methods. So here's an example of a statement of cash flows format. And if you look at this where it says cash flows from operating activities, investing activities, and financing activities, they are showing where you're going to make your breaks in the creation of the financial statement. Ultimately, you come to a computation that determines what is the net increase or decrease in cash for the period. Then you can add that change to the cash for the beginning of the period to get the cash at the end of the period. Now, why is that important? Because cash comes to companies in different parts of its life cycle. Typically, when a company gets started, they need to get lots of financing because they normally don't have cash to start with. We generate financing activities from either borrowing from a bank or some other creditor or the sale of stock. Both of those are considered financing activities. As a company matures over time, they don't need to sell additional shares of stock, nor do they need to borrow any more money from a bank. They can generate their cash from their normal operations or from their investments.